welcome. You're watching Market Guru, and we have with us Sampath Reddy, Chief Investment Officer at Bajaj Allianz Life Insurance. Morning, Sampath. Thanks for joining in. Sampath, to begin with, how does it feel? The market seems to have been picking back up on the winning streak. We're close to our life highs once again in trade. Is it looking sustainable around these levels, new highs in sight in the near future?
Yeah, I think, overall the valuations has been a challenge for the market for quite some time, as we have said, earnings growth has not been very good for the last couple of years. So that has been a key challenge for the market as such. But if you look at the growth from the current second half onwards, certainly we are believing that earnings growth in the corporate sector will pick up accelerate from the second half of this financial year onwards. If you look at it, the base is also very favorable from the second half onwards, because last year during the quarter three we had seen a demon impact as well. So all of that will start playing up, so better growth for the second half. So overall, we are hopeful that earnings growth will recover from the second half. If the earnings growth were to come back, I think the market valuation market level will sustain. So the key from here on is to, if investors were to make money in the short to medium term, we need to, see the growth in the corporate earnings. I think we are hopeful that, the growth will come back for sure in the second half of this financial year. So in that sense, we believe that, for the, markets are, pretty much, good to even buy at these levels, with the key assumption that, earnings growth will recover from the second half onwards.
I'm very surprised you're saying that, because over the last 3 years, every fund manager, every analyst has always said that, earnings will recover in the next quarter. Time and again, we've been through over 32 quarters where that's actually not happened. What makes you so convinced this time around that the game will change? Because businesses are still not doing well for whatever it's worth. I mean, it's a clear reflection in what we saw in earnings this time around. You see GDP, you see growth. There is trouble in paradise.
Right. No, I agree that, it's in fact, since last 3 years, earnings growth has been disappointing, most of the time, almost every year in the last 3 years. At the beginning of the year, we were all looking at about 15-20% earnings growth, but, we ended up near zero kind of earnings growth in the last 3 years. Now, that is true. But having said that, it does not mean that, we'll continues to be, wrong in forecasting. And that's, if you look at, the growth potential as such, India continues to have a very good growth potential, in terms of, demand for infrastructure continues to be very, very strong. The only challenge is, how do we get the credit growth flowing into the, corporate sector? Today, if you look at the, most of the, the banking credit per se is going towards, the retail side of assets. That's why you're seeing the retail, the consumption-led growth only happening, But, how do we, convert this, the growth into the broad-based, which is also, capex-led growth? So that, I think, is a challenge. I think, with the most of the, with the capacity utilization improving, we could see that capex coming back in the next financial year onwards. But, for the second half, most of it will be because of the base effect. Because last year second half, we had seen the impact of the demon, that continued for almost an entire 6 months. So that, I think, will act as a, buffer for the growth in the current financial year, second half. But from the next fiscal, it has to be basically the capex recovery-led growth. If that does not happen again, we could see a challenge, market, could, maybe, take a pause and maybe even correct.
So fair to assume you're going to be positive and give the markets one more chance and see how the next couple of months play out?
Yeah.
Are you factoring GST impact? Because I think that's managed to hit business as well. So if it is life past GST, we are over and above demonetization. But GST still is something we talk about. It is impacting business. Do you not anticipate the effect of that in the next couple of quarters?
Right. The GST impact is, to some extent is already we have seen in the quarter one, and maybe, to a little bit of an impact could be there in the quarter two, which is the current quarter. As I said, from the quarter three onwards, second half of the financial year, this financial year onwards, we could see a good growth. GST, that's a temporary disruption because of, because of the change over the tax regime, all of a sudden, because some of the SMEs and all were not prepared to, move the system to, into the new tax regime. Because of that, we are seeing a slowdown of that. But that is a temporary. As I said, this quarter we would probably, the GST impact will be completely behind. From the quarter three onwards, we will not see a GST-led slowdown for sure.
Sampath, this is going to be a tough question, but what do you think is the difference between you and an FII? Because an FII in the last 3 months has been dumping the Indian markets, while DIs continue to support these markets. Is this a case of information arbitrage that you have over foreign institutional investors, or is it just simply the fact of lack of options in the market, and hence it could potentially be good money chasing bad assets?
No, okay. Let me put it this way: today, the good money is certainly not chasing the bad assets. If you look at this time around the bull market, most of the money is going into the better quality companies. Today, if you look at it, the market valuations are concerned, but the money is certainly not going into the unproductive asset. Most of the, if you look at most of the IPOs and QIPs and fundraising, almost all of it is gone to the very good quality companies where return on capital employed is very good. So there is certainly not that good money is chasing the bad assets. It's just the valuation could be bit of a concern. But coming to the FIs versus DIIs, DIIs obviously do not have much of an avenue to go outside of India. Whereas FIs have a plethora of options. If they find it, the valuations are attractive in other parts of the countries, other parts of the world, they may reallocate their assets. For them, it will be the opportunity space is much larger. That could be one of the reasons. But if you look at even FIs, maybe a month or two, they've been net sellers, in the past several years. But in a longer term basis, every financial year, they've been a net buyers, by and large. We believe that FIs will also be the net buyers in the longer term perspective. Maybe in a couple of months they could withdraw some funds, etc. That could always be there.
So what is it that you're telling your customers who are coming in with a lot of money? Is the pace of inflows reduced after the markets have hit these recent highs, or is the euphoria even more right now because there's a sense of feeling left out between investors?
Yeah, if you look at the mutual fund inflows, that it clearly shows that inflows continues to be very strong. And if you look at our own insurance sector, insurance is still lagging behind in terms of net inflows wise. But since our ULIP sales have been picking up for the last 1.5 years, we believe that even insurance will be the net buyers in the equity market for the next financial year. But this financial year, we would be, I would say, marginal. I would say the neutralish kind of inflows we will have.
Let's talk about sectors then in that case. I want to start with some sort of euphoria or bottom fishing that's emerged in the pharmaceutical pack. I mean, there's also been some improvement in the kind of US FDA approvals that we're seeing. There have been no sort of Form 483s either in the last 3 to 4 months. Do you think the tide has changed for pharma pack, and is it now time to start cherry picking the sector?
Yeah, between the pharma and IT, we've been preferring the IT services as a sector, because both of them are hinged on to mainly the US exposure, US-led growth, and also, basically both of the sectors will also have the currency headwinds. So between the two sectors, we are relatively preferring IT services because, there the predictability of earnings is much, much better. In the case of pharma, even though the valuations have come down a lot, market stocks have corrected a lot in the last 2 years, we have relatively been preferring the IT services sector. But yeah, to speak on the pharma as such, it seems to be the era of earning, the warnings or FDA warnings and warning letters is over. Now the time is only the resolution. I think almost all the companies were issued some sort of a warning letter from the FDA, and now that was the case in the last 1 year. Now is the time for all of these companies to work with that and get resolution from the US FDA side. So if you look at pharma sector as such, the negative news is certainly behind. Almost all the companies are facing the FDA issues. It's just the now onwards, you could only see the positive figures. If and when a company comes out or successfully from the US FDA observation, then we could see the rally, in the pharmaceutical stocks. I would say the bottom, the worst is behind for the pharma stocks, but relatively, the companies which are export oriented, we have been preferring the IT services.
Right. What about Sampath? What about more local and domestic themes? Are you buying into this whole consumption theme right now, or is it time to take profits off the table?
Yeah, the valuations are a bit of a concern for consumer services, consumer sector. But even if but they're all very good quality companies with very high return on capital and a very good cash flows, and also long-term sustainable kind of a growth potential kind of a companies. Even if the valuations are on the higher side, if probably 1 year you could not see much of return, because of 1 year growth could go in terms of valuation correction. But from a 5 to 7 year perspective, the consumer companies would still give a very good growth. So valuation is a bit of a concern there, but we still continue to like them or own them because they are one of the better placed sector at this point of time.
Right. Well, also, Sampath, talk to me about other sectors like infrastructure, capital goods. CapEx is still slow, and it's not really translating into a positive cash flow for a lot of these infrastructure construction companies on cap goods as well. Are you expecting the pickup to happen? And if yes, give me a reason of why you think that's going to happen, and also a timeline in terms of expectation.
I think the capital spending is not yet happening for sure, and even whatever the little bit of spending which is going on in the road sector, that is not leading to any major growth for the construction companies, rather at least in the cash flows wise. So we've not been liking the infrastructure capital goods space even as we speak right now. Even that, if you look at the banking credit as such, if you look at almost entire incremental credit is growing only to the retail side of the lending. So, that is one of the leading indicators if one were to see that. There's certainly that clearly says that, capex recovery is not at least is happening as we speak. That's why we've been avoiding that sector. The things which we're preferring that, within the I would say more broader market, we've been liking the banking sector, where which one is more hinged on to the retail side of the assets. That's where the growth continues to be good. So the challenge for the infrastructure sector is to how do we ensure that the money flows happens to the the corporate sector or infrastructure sector. That is, I think, critical for the recovery in the capital good companies and infrastructure sector.
Sampath, you must be, of course, aware of the mixed sort of news in the OMC pack yesterday. First, of course, commentary that there won't be any cut in excise duty. Then secondly, margins may be impacted. And thirdly, of course, the oil minister confirming that there'll be no intervention in terms of price fixing by OMCs. Is this a good space? Do you still like the likes of an HPCL, BPCL, IOC, especially with the kind of clarity that we've now got in terms of margins for now being maintained for the oil sector?
Right. With the crude prices coming down and deregulation of the marketing, the marketing side of the business as well, these stocks have been doing very, very well. And with the petrol prices and diesel prices going up, to almost the all-time high levels, there has been a concern in the market overall. But if you look at currently the inflation, CPI inflation is very, very comfortable. Given that given that already low inflation, we do not see the government coming and intervening in the petrol and diesel prices as of now. That is what even the minister also seems to have clarified. So because of that, we don't see much of a risk to the OMCs, at least at this point of time. I don't think government will go back on the deregulation of the petroleum products. So I think given that with that view, we continue to believe that oil and gas sector will also do well.
What about city gas distributors? So stocks like GAIL, IGL, do you think they could remain to be the flavor of the season?
Yes, in fact, they continue to do well. They are more like, utility companies with a reasonably good return on capital employed. Both the city gas distribution companies, Indraprastha Gas and, Mahanagar Gas, they've been doing very well. In fact, their volume growth has also been good. So, that, I think, that sector is not even corrected with the yesterday's news because they are, continues to, because they are not likely to get impacted with the, the petroleum price, direct. So I think the city gas companies certainly do well, and we liking them. In fact, within that, within the oil and gas space, maybe the gas companies like city gas distribution companies will have a even better potential than the oil marketing companies.
Reliance Industries, Sampath, it hit a life high yesterday.
Because if you look at it, the refining margins in this quarter have gone up a lot. Maybe because of that is the impact of hurricane in the US. Whatever could be the reasons, the refining margins continues to be very, very strong. I think that is what is helping the Reliance Industries as well.
Also, while we are talking about a few of those thematic conversations, we've talked about OMCs, gas distributors, RL. What about the RECs and PFCs of the world? Spot power prices are trading at a 3-year high. Any of these that you'd buy?
No, I mean, in the financial sector, we've not been liking the government-owned companies because of the continued troubles with the NPS. I think we would be better off buying private sector financial, which are more linked onto the retail side of the lending. So that's what we've been liking.
Hi, thanks, Sampath. Good talking to you. Hopefully, we'll touch base with you soon and, of course, talk more stocks. With that, we wrap up this edition of Market Guru. Thanks for watching.